Hey everyone, Coach Investor back to another Intel video for you today. So let's talk about their unquestionable leadership, as Pat likes to say. Just kidding, we're going to talk about the Q4 earnings report and a couple of points that were raised during the earnings call. At the time of making this video, the stock is obviously down around 2.6% or so. That does not mean that the quarter was bad. Actually, the quarter was good. They beat on estimates. For guidance was a bit weak. Again, this is something that they mentioned in the past quarter. Gross margins will get hit because of the ramp up of the 10 nanometer and because of all the expansions and the expenses that are rising right now. If you want to catch up, if you want to continue to grow, and in Intel's case, if you want to start growing and becoming a growth company, then obviously that means that your margins will get hit, and that's exactly what's happening. And this is something that we already know. Now, on the positive side, they raised dividends by 5%. So if you're in it for the dividends, that's great. Also, important to note, if you're not following Intel for a while, during the earnings call, we don't get a lot of information. That's because on February 17, there is the Investors Day, and that's where they reveal most of the big information. So if you're interested in that, make sure to subscribe and like this video, as I will be covering that Investors Day as well. So let's talk a bit more about this quarter. Alright, so they beat expectations on revenue, gross margins, and earnings per share in Q4. It's the highest quarterly and full year revenue ever. So although the stock might not be moving that much, it's the best year ever. They're advancing their IDM 2.0, announced a US manufacturing site in Ohio. It's going to cost them $20 billion, demonstrating superior agility in a supply-constrained environment, and then optimizing investments, unlocking shareholder value, completed first close of NAND sale, and announced intent to take Mobileye public. We talked about that as well on the channel, and it's raising the dividend 5%. To put this into numbers, revenue came in at $19.5 billion. That's more than $1.2 billion above their guidance, and that's up 4% year over year. So yes, don't expect AMD or Nvidia Lite year over year comparisons here. It's not going to happen. Also because, well, they're generating $19.5 billion. Gross margin came in at 55.4%. That's 1.9 percentage points above their expectations, but that's actually down 4.6 percentage points year over year. Earnings per share came in at $1.09, 19 cents above their guidance, but again, down 26% year over year. As for the full year 2021, revenue came in at $74.7 billion, up 2% year over year and $1.2 billion above their own guidance. Gross margin came in at 57.7%, down 1.7 percentage points year over year and 0.7 percentage points above their own guidance. And the EPS for the full year came in at $5.47, 19 cents above their guidance, and that grew 7% year over year. So far so good, right? We're going to go even deeper in just a bit, looking at the client, the data center side as well, and then the outlook for Q1. But first, I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 free stock picks from their popular product, Stock Advisor. Now, Stock Advisor has beat the market by more than 4x. So all you have to do is go to fool.com/couchinvestor to get your free 10 stock picks now. All right, the CCG segment is obviously the most important one for Intel as of today. Revenue is actually down 7% to $10.1 billion. That was $10.9 billion just a year ago. Same thing with operating income, that's down 23%, so not that great. But if you look here on this side, we can see that for the CCG platform, PC volumes is down 18% year over year. Notebook and desktop average selling price are up 11 and 14%. They say here lower revenue on ecosystem constraint and modem ramp down, lower operating income on less reserve sell-through and investment for Intel 4, And during the earnings call, they explained that the PC volume being down 18% might seem a lot, but that's because Q4 of last year was actually a very, very good quarter. But if you look at the growth relative to the total addressable market, it's more aligned to the industry. They also mentioned during the call that the PC market, grew by 15% in 2021. Now, the data center group actually surprised me a lot because, well, revenue is up 20%, so that's very, very nice to see. You can see here great numbers on the side for the platform. For the cloud SP, it's down 5%. Now, regarding the cloud aspect, so the return year-over-year growth in cloud, Pat admitted during the call that obviously they started behind, so they had to play catch up from the start, so it's going to take a while, but they have seen some great signs. But as you can see, the other two segments are up very, very nicely there. Explain here as well, record revenue on strong enterprise demand. We can see here 53% year-over-year growth, lower operating income on a one-time Intel federal charge, 10 nanometer mix, and increased investment. And then the last segment is the IoT, Internet of Things, and then Mobileye. So again, same thing here, record IoTG revenue up 36% year-over-year, and operating income up 120% year-over-year, driven by COVID recovery. Now, as for Mobileye, revenue is up 7% year-over-year on improvement in global vehicle production, but operating income is down 10% year-over-year. And as for PSG, no, again, not the football team. Revenue is up 15% year-over-year on strong demand, and operating income is up 19% year-over-year. As for next quarter's outlook, they expect revenue to come in at $18.3 billion. That's down 1% year-over-year. Gross margins to take a hit already, 52%. That's down 6.8 percentage points year-over-year. And then earnings per share to come in at 80 cents. That's also down a lot, 40% year-over-year. Now, during the earnings call, a lot of the questions were with regards to capex and obviously the reduction of gross margins. How long will it take until we see that going back up? So in the short term, they expect it to be between 52 and 53%. In the long term, they expect it to come back, maybe not back up to the 60% or so, close to 60, because with the foundry business, that will hit margins as well. But they expect it to go back up over those 52 and 53% in the long term. Now, obviously, with Intel and their plans, spending is increasing, which is hitting those margins as well. But this is something that they have to do. They know this as well. They have been behind on a couple of things for a couple of years now, so spending is necessary. Now, with regards to the Ohio and Arizona factories, doesn't really matter what happens with the CHIPS Act, whether it passes or not. Obviously, it's going to help them a lot if it does, it's going to help the industry a lot, but they're going to build it regardless. Just the size that's going to change in Ohio, whether it's going to be a big one or a smaller one. Also in Europe, there are some positive signs that such a similar bill is going to pass, and it's extremely important for the world because we need that supply chain to come back to Europe and to the United States and stop relying on whatever is going to happen there in Taiwan and in China. So to conclude, as an Intel shareholder, when I first bought my shares, I knew very, very well that when Pat came in, the way he talked, the way he presented the roadmap, it's going to take some time, all right? Those factories won't get built in a day or two. It's going to take some time. We've seen that with Tesla as well. Building the factories take time, and then ramping up takes time as well. And all of that costs money. That's why it's hitting the margins as well. This is something you need to take into consideration. But to say that Intel isn't moving into any direction is false in my opinion. I think Intel is moving in the right direction. They're still generating approximately $75 billion each year. It's not bad for a struggling company, right? Obviously, you won't see those 50-60% year-over-year growth like AMD or Nvidia. But then again, they aren't generating $19 billion in revenue each quarter. So you see the difference there. Overall, the semiconductor industry is big enough for a lot of players. And again, Intel going into foundry business is a game changer for me, especially in the long term. So that will be it for this video. Let me know down in the comments below what you thought about this quarter. If you listened to the call, what you think about that, let me know down in the comments below. And if you like this type of videos, give it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. And as always guys, take care, stay safe, and see you all in the next video. Bye bye.